Okay, let's dive into this. Welcome to The Explainer. Today, we're going to be decoding what is genuinely one of the most fascinating and honestly powerful systems in the entire modern world. We are literally stepping inside the ultimate economic control room to figure out the whole shebang of monetary policy. I want you to think about your wallet for just a second. Every single time you go to buy a car, take out a mortgage, or, even just decide to stash away a little extra cash at the end of the month, you probably think you're making those financial choices entirely on your own, right? But what if I told you there's this invisible institution, a central bank, just quietly pulling the strings in the background, and they are directly influencing almost every single daily spending decision you make? So, how exactly do they pull this off? Well, let's get right into our first section and look at what monetary policy actually is. At its core, monetary policy basically boils down to the big decisions made by a central bank. They're tweaking the money supply and interest rates, and their ultimate goal here is to influence total aggregate demand and just keep the economy's big picture macroeconomic objectives on track. It is literally like pulling levers on some giant, complex machine. If the economy is acting a bit sluggish, they pull a lever to speed it up. If it's overheating and running way too hot, they pull another lever to slow it down. But hey, before we can start pulling any of these levers, we really need to know what it is we're actually controlling, right? The money supply isn't just that physical cash stuffed in your pocket. It's the total amount of money floating around the entire economy at any given moment. Sure, that includes your standard banknotes and coins, but it also includes all those digital bank deposits and the massive reserves held by the central bank itself. Oh, and fun fact, if you're looking at the US specifically, they actually refer to this whole grouping as the M2 money supply. All right, so how does the central bank manipulate that massive supply of money? Let's move on to our second section and talk about the most famous tool they have, the interest rate lever. When they manipulate interest rates, they are fundamentally changing the financial incentives for absolutely everyone in the economy. It's this constant, super delicate balancing act between the cost of borrowing money on one side and the reward for saving it on the other. And when the central bank decides to change their base rate, commercial banks pretty much always follow suit. And this brilliantly illustrates how just a single, tiny downward tweak at the central bank ripples out into the real world. Let's pretend they lower the interest rate right now. Look at the consumer column there. Suddenly, your existing loans and mortgages, they become cheaper. And because you're spending way less on servicing that debt, your discretionary income naturally rises. You are literally incentivized to go out and spend money on big-ticket items like cars or holidays. Now look over at the business side. Lower rates mean cheaper loans for them too. So businesses are suddenly incentivized to borrow money to finance major capital investments. They expand operations, they buy more machinery. So one single lever pull, and boom, suddenly the whole economy is spending and growing. But you might be wondering, what happens when that lever gets stuck? That brings us to section 3, where things get a bit more complex: digital reserves and quantitative easing. You see, sometimes those traditional tools, like cutting interest rates, well, they just aren't enough. Think back to the 2008 global financial crisis, or even more recently during the 2020 pandemic. Central banks slashed interest rates down to nearly zero, but the economy was still completely stalled out. They desperately needed a much more direct way to inject money into the system. And this is exactly where quantitative easing, or as it's usually called, QE, steps onto the stage. Let's walk through how this works step by step, because the mechanics here are genuinely fascinating. Step 1, the central bank quite literally creates brand new digital money out of thin air. Just poof! Step 2, they use this shiny new digital money to go out and buy government bonds and other assets from commercial banks. Now for step 3, because the central bank just bought all those bonds, these commercial banks are suddenly sitting on massive, massive piles of cash, which leads us to step 4. With these highly increased cash balances, banks now have a much higher capacity to lend to firms and normal households. This sudden flood of lending stimulates total demand in the economy. Now, just to give you an idea of the sheer scale we're talking about here, listen to this figure. $600 billion. That is the massive, almost incomprehensible amount of money the United States Federal Reserve injected into the money supply through QE right after the 2008 to 2012 recession. All of that just to boost liquidity and get banks lending again. Mind-blowing, right? So, okay, we've got our tools, interest rates, and QE. Now let's jump to section 4 and look at the 2 directions these levers can actually be pulled: expand or contract. Central banks are constantly having to balance the scales here. On the left side, we've got expansionary policy. This is when the bank lowers interest rates and cranks up the QE. The goal here is highly optimistic. They want to warm up a cold, sluggish economy, generate serious economic growth, and push us toward full employment. But the risk? Well, if demand grows way too fast, you get hit with demand pull inflation. Now flip over to the right side, contractionary policy. If the economy gets dangerously hot, the bank has to step in, increase interest rates, and slam the brakes on QE. The goal is entirely focused on cooling down growth and reining in that high inflation. But as you can probably guess, the risk here is severe. Tightening up the money supply can lead to direct job losses and significantly harm overall economic growth. All right, let's shift our focus away from the theory for a minute and look at Section 5, the impact this actually has on the real world. So the crucial point is understanding the positive domino effects of an expanded money supply. When you expand that money supply, you generally see a really nice rise in consumer expenditure and business investment. This directly increases overall economic growth and drives up employment, mainly because, expanding businesses need to hire more workers. It provides necessary finance for firms to grow their operations, and of course, it leads to those lovely lower interest rates on your current loans. However, to keep things completely impartial here, we really have to flip the coin. Pumping money into the system isn't just some magic cure-all. When you have too much money chasing too few goods, it causes demand pull inflation. Basically, the internal value of your money falls, which means your everyday groceries suddenly cost a whole lot more. Furthermore, with all that extra cash, consumers might start buying way more imported goods from abroad, and that can actually worsen a country's current account deficit. And finally, when bank lending becomes a little too easy and cheap, there's a very real risk of households and firms getting dangerously trapped in a cycle of debt. Which brings us to a vital question and our final section today. Section 6, does this control room actually always work? Let's talk about the limitations. Well, the reality of the situation is that the central bank's levers are definitely not instantaneous. First off, you've got massive time lags. It can literally take months or sometimes even years for a policy shift to actually be felt by the average person on the street. Second, millions of consumers are completely insulated from these interest rate changes because they are locked into fixed-term agreements. I mean, think about it. If you have a 30-year fixed-rate mortgage, the central bank tweaking their base rate today doesn't change your monthly payment tomorrow at all. But honestly, the biggest limitation of all is just human behavior. Look at this shocking number here, negative 0.25%. In a desperate attempt to force economic growth, Japan's central bank did the unthinkable. They pushed interest rates into the negatives. They were essentially, literally, paying people to borrow money from the bank. Crazy, right? But doing that highlighted a really critical flaw in monetary policy, which is perfectly captured in this quote from our sources. If the interest rate was at zero and consumers were not confident in the economy, they will not be borrowing more money just because it's cheap. Human psychology can completely override the math. If you are terrified about losing your job tomorrow, you're sure as heck not going to take out a huge loan to buy a new car today, even if the bank is literally paying you to do it. Which ultimately leaves us to ponder the real limits of economic control. The central bank can pull all the levers they want, they can flood the commercial banks with endless digital cash, but at the very end of the day, the final decision rests entirely with the consumer. If borrowing is essentially free, but your confidence is sitting at absolute zero, will you spend? It's a pretty fascinating question to leave you with. Thank you so much for joining me for this explainer, and keep questioning how the invisible gears of our economy really turn.